You didn't lose money because the trend reversed. You lost money because the reversal started while you were still calling it a pullback. That's the hidden cost. Not the losing trade itself, but the delay in recognizing that the market has changed character. And the uncomfortable part. The clues were often visible before the damage appeared on your account. Think about it. How many times have you watched a strong trend begin to hesitate, only to convince yourself that it would continue? How many times did you add confidence right when the market was quietly removing it? A trend reversal rarely announces itself. It leaves footprints. The first footprint is not a price collapse. It is a loss of efficiency. The market stops moving the way it used to. A healthy uptrend pushes higher with relatively little effort. Then suddenly, the same buying pressure produces smaller results. Progress slows. Why does that matter? Because trends are driven by conviction. When conviction weakens, price behavior changes before direction changes. The crowd sees the reversal later. The tape often sees it first. Now consider the next stage. Price makes a new high, but participation shrinks. The move looks impressive on the surface, yet something feels different underneath. Then a sell-off appears. Not necessarily a dramatic one, just enough to test whether buyers still have control. And here's the question: what happens after that sell-off? This is where the reversal formula begins to reveal itself. A trend weakens. The market attempts one more push. That push fails to attract the same commitment. Then support breaks. Cause and effect. Weak momentum creates vulnerability. Vulnerability attracts profit-taking. Profit-taking creates pressure. Pressure exposes the lack of fresh buyers. The result is a reversal. Notice what is absent from this formula: predictions. The market does not pay you for forecasting. It pays you for observing. There is a difference. One trader argues with price. Another trader studies behavior. Which one do you think survives longer? The practical application is surprisingly simple. Watch how price reacts at important levels, rather than focusing only on whether those levels are reached. A strong trend should respond strongly. If it doesn't, pay attention. Look for rallies that travel shorter distances than previous rallies. Look for pullbacks that recover more slowly than before. Look for moments when good news fails to produce meaningful buying, or bad news suddenly creates outsized selling. These are not random events. They are evidence. And evidence is what separates a professional mindset from a hopeful one. The reversal formula is not a single pattern. It is a sequence. First, strength fades. Then expectations remain high. Then reality disappoints those expectations. Finally, price adjusts to reflect that new reality. Can you see why so many traders miss it? They focus on the final stage and ignore the stages that came before. By the time the reversal becomes obvious, the opportunity is often gone. The real edge comes from recognizing the transition while the crowd is still interpreting weakness as temporary noise. The market has a way of rewarding patience right after it has made impatience feel intelligent. A trend starts to weaken. Price hesitates. A sharp move appears against the prevailing direction. Suddenly, the possibility of a reversal becomes visible. And that is exactly where many traders make their mistake. They see possibility and treat it as proof. Have you ever entered a reversal trade because it looked like the market was turning, only to watch the original trend resume as if nothing happened? The problem is not that you were wrong about the possibility of a reversal. The problem is that possibility is cheap. Evidence is expensive. A market can show signs of weakness for a long time before it actually changes direction. During that period, countless traders attempt to predict the turning point. Some get lucky. Most become fuel for the trend they are trying to fight. Why does this happen? Because a trend is not reversed by appearance. It is reversed by behavior. A single sharp move means very little by itself. Markets can move violently and still continue in the same direction afterward. A reversal requires something more important. It requires proof that the forces driving the old trend are losing control. That proof arrives through action, not opinion. Price must do something different from what it has been doing. In an uptrend, buyers have been consistently defending weakness and producing higher prices. If a reversal is truly developing, that behavior must change. Support that once held begins to fail. Recoveries become less effective. Attempts to push higher lose follow through. Notice the difference. You are no longer asking what might happen. You are observing what is happening. That distinction changes everything. When traders enter on suspicion, they are effectively paying for information they do not yet possess. They are making a bet before the market has revealed its hand. When traders enter on evidence, they allow the market to reveal part of the story first. Yes, they may enter later, but they gain something far more valuable than a few extra points. They gain confirmation that the conditions they are betting on actually exist. Would you rather be first or be right? The market rarely pays a premium for being first. In fact, the obsession with catching exact turning points often creates the very losses traders are trying to avoid. Because every failed reversal attempt teaches the same lesson. The market had not changed. Only the trader's expectation had. This is why evidence has to come before execution. The goal is not to predict the reversal. The goal is to participate once the reversal begins proving itself. That may sound like a small difference, but it creates a completely different trading experience. Instead of constantly guessing, you start observing. Instead of forcing trades, you start qualifying them. Instead of reacting to every dramatic candle, you wait for behavior that confirms a genuine shift. And what does that look like in practice? It means treating every suspected reversal as a hypothesis. The first sign of weakness raises a question. The next price reaction provides information. The market either supports the reversal case or weakens it. Each piece of evidence carries weight. As the evidence accumulates, uncertainty decreases. As uncertainty decreases, the quality of the opportunity improves. The trader who understands this is no longer hunting turning points. He is evaluating transitions. Because a reversal is not a moment, it is a process. And the market leaves clues throughout that process for anyone willing to wait long enough to see them. The challenge is that waiting feels uncomfortable when price starts moving before you are involved. It creates the fear that the opportunity is escaping. Price direction gets all the attention. Yet direction is often the last thing to change. Long before a trend reverses, something else begins to deteriorate. The trend loses efficiency. At first, the change is subtle. The market is still moving in the same direction. New highs are still being made. The trend still looks healthy to anyone focused only on where price is going. But if you look closer, a different story begins to emerge. The distance traveled by each advance starts shrinking. Progress requires more effort. What once took a few sessions now takes many. The trend is still alive, but it is no longer producing the same results from the same amount of energy. Why is that important? Because every trend depends on momentum. Not momentum in the indicator sense, but in the practical sense. A trend survives because one side of the market can consistently push price forward. When that ability weakens, the first symptom is not reversal. The first symptom is decay. Think of a vehicle climbing a hill. The car may still be moving upward. From a distance, nothing appears wrong. Yet the engine is working harder while the speed gradually decreases. The direction remains the same, but the underlying strength is changing. Markets behave in a similar way. A powerful trend tends to produce clean movement. Price advances with relatively little resistance. Pullbacks remain controlled. Recoveries happen quickly. As strength fades, those characteristics begin to change. Advances become shorter. Corrections become deeper. Recovery periods become longer. The market starts spending more time working for less reward. Cause and effect. When buyers or sellers are losing influence, they can still push price in their favor. They simply cannot do it with the same authority they once had. The result is gradual deterioration in trend performance. This is where many traders make an expensive mistake. They evaluate a trend by its destination rather than by its efficiency. If price reaches another high, they assume the trend remains strong. If price reaches another low, they assume the downtrend remains healthy. But a trend can continue making new extremes while simultaneously becoming weaker underneath. Have you ever noticed a market making new highs that somehow feel less convincing than previous highs? That feeling often comes from observing trend decay without consciously recognizing it. The market is revealing information through the quality of movement rather than the direction of movement, and quality matters. A trend producing smaller advances is consuming strength. A trend requiring longer recovery periods is consuming strength. A trend repeatedly struggling at levels it once passed effortlessly is consuming strength. The market is effectively spending more energy to achieve less progress. That imbalance cannot continue indefinitely. Eventually, one of two things happens. Either fresh participation enters and restores the trend's efficiency, or the deterioration continues until the trend can no longer sustain itself. This is why measuring trend decay is so valuable. It allows you to observe weakness before weakness becomes obvious. Not because you are predicting a reversal, but because you are monitoring the condition of the existing trend. The focus shifts from asking, has the trend reversed, to asking, is the trend performing as well as it used to? That is a completely different question, and often a much more useful one. In practical terms, start comparing the present behavior of a trend to its earlier behavior. Observe how far price travels during impulsive moves. Observe how much time is required to regain lost ground. Observe whether progress is becoming easier or harder. The answer is rarely hidden in a single candle or a single day. It appears through comparison. A healthy trend leaves evidence of strength. A weakening trend leaves evidence of deterioration. The difference is not always visible in direction, but it becomes increasingly visible in performance. A trend reversal is not really a change in price. It is a change in control. Price is simply the visible result. When traders focus only on the chart, they often see the outcome without understanding the process that produced it. Yet every reversal begins with a transfer of influence from one side of the market to the other. That transfer rarely happens in a single moment. It unfolds gradually. In a healthy uptrend, buyers control the market. That does not mean price rises every day. It means that whenever pressure appears, buyers absorb it. They have enough demand to overcome supply. As a result, the market continues moving higher. The same principle applies in reverse during a downtrend. Sellers maintain control because they consistently overpower buying attempts. Control is the key word. The market does not reverse because the losing side suddenly becomes stronger. It reverses because the winning side becomes less dominant. Think about that for a moment. A kingdom does not fall the day invaders arrive. It falls when the defenses can no longer hold. The weakness appears before the takeover. Markets behave in much the same way. The first stage of a reversal is often a failure of control. The dominant side begins losing its ability to dictate outcomes. Reactions that were once predictable become less reliable. Areas that were consistently defended start showing signs of vulnerability. At this stage, the trend may still be intact. Price may still be moving in the original direction. But the balance of power is beginning to shift beneath the surface. Then something important happens. The opposing side starts achieving results that were previously difficult or impossible. In an uptrend, sellers suddenly push price farther than they could before. In a downtrend, buyers suddenly sustain advances that would have previously failed. Why does this matter? Because markets reveal power through outcomes. Anyone can enter an order. Anyone can express an opinion. What matters is whether those actions produce meaningful movement. When one side begins generating larger reactions, while the other side struggles to maintain control, the market is revealing a redistribution of influence. Cause and effect. Weakening control creates opportunity. Opportunity attracts participation. Participation strengthens the opposing side. The stronger the opposing side becomes, the harder it becomes for the original trend to continue. This process feeds on itself. Every successful push by the emerging side encourages more participation. Every failure by the dominant side weakens its ability to maintain authority. The transfer accelerates. What makes this difficult to recognize is that both sides coexist during the transition. Buyers do not disappear during a bearish reversal. Sellers do not disappear during a bullish reversal. The market becomes a battleground. For a period of time, both sides are actively competing for control. Price fluctuations during this phase often appear confusing because the outcome has not yet been decided. Have you ever looked at a chart and felt that the market was becoming more difficult to read? Often, what you are observing is not randomness. You are observing competition. The old trend is attempting to continue. The emerging force is attempting to replace it. Price moves back and forth because the transfer is still in progress. This is why reversals are processes rather than events. Control must first weaken, then resistance must emerge, then influence must shift. Only after that does a new trend gain enough authority to sustain movement in the opposite direction. The practical lesson is to stop viewing reversals as isolated turning points. Instead, study the evidence of control. Ask yourself which side is consistently achieving its objective. Which side is producing stronger reactions? Which side is forcing the other to retreat? These questions move your attention away from individual candles and toward the deeper mechanism driving market behavior. Before every reversal trade, there is a question that matters more than any prediction, indicator, or opinion. What has actually changed? Not what could change. Not what should change. Not what you hope will change. What has already changed? This question sounds simple, yet it separates observation from assumption. A market can look extended. It can look overbought. It can appear exhausted after a long advance. None of those conditions automatically create a reversal. They merely create the possibility of one. The market does not reverse because traders think it has gone too far. It reverses because something within the behavior of price is no longer functioning the way it previously did. That distinction is important. Consider a trend that has been advancing for weeks. At some point, someone will call the top. Then another trader will call the top. Then another. Eventually, one of them will be right. But being right once does not mean the process was sound. The better question is not, how high can this market go? The better question is, what evidence tells me the conditions supporting the trend have changed? Can you see the difference? One question focuses on prediction. The other focuses on diagnosis. A doctor does not begin with a treatment. He begins by identifying what has changed in the patient. The market deserves the same approach. Every reversal trade is based on a claim. The claim is that the existing trend is no longer operating as it was before. If that claim is true, there should be evidence. There should be observable changes in behavior. Without evidence, the trade becomes little more than speculation disguised as analysis. This is why the quality of your question determines the quality of your decision. When traders ask whether a market is too high or too low, they direct their attention toward price levels. When they ask what has changed, they direct their attention toward market behavior. Behavior reveals information that price levels alone cannot provide. A market can remain expensive longer than expected. A market can remain cheap longer than expected. But no trend can continue indefinitely without maintaining the characteristics that support it. Once those characteristics begin changing, the market starts communicating something new. The challenge is that traders often become distracted by outcomes. They see a sharp move and immediately assume the answer has arrived. But a single move is not necessarily a change in condition. The question remains the same. What has changed? Has the market begun responding differently than before? Has behavior shifted in a meaningful way? Has the evidence supporting the previous trend weakened? Until those questions are answered, the reversal case remains incomplete. Notice how this approach changes your relationship with uncertainty. You no longer need to know exactly where the market will go next. You only need to determine whether the market is behaving differently than it was before. That is a much narrower problem. And narrow questions often produce better answers. In practical terms, make this question part of your routine whenever a potential reversal appears. Before considering the trade, pause and ask yourself, what specific change am I observing? If the answer is vague, the evidence is probably weak. If the answer depends on opinion, the evidence is probably weak. If the answer relies on what you think should happen, the evidence is probably weak. The strongest answers are observable. They exist whether you hold a position or not. They exist whether you are bullish or bearish. They are present on the chart regardless of personal belief. This habit forces clarity. It prevents you from treating possibilities as facts. It prevents you from confusing market movement with market change. Most importantly, it keeps your attention fixed on the one thing that matters before any reversal trade is considered. Identifying whether the market you are looking at today is genuinely different from the market that existed yesterday. The ability to spot a trend reversal is often described as a skill. In reality, it is usually the result of a process. When traders consistently identify changes in market direction before others, it rarely comes from intuition alone. What looks like instinct is often the product of repeated observation. They notice things because they have trained themselves to look for them. That raises an important question. What exactly are you looking for each day? Without a process, attention becomes random. One day you focus on price. Another day you focus on news. The next day you focus on a pattern that happens to catch your eye. Random observation produces random conclusions. A process creates consistency. The market presents thousands of pieces of information every week. Most of them are irrelevant. The challenge is not finding more information. The challenge is repeatedly examining the right information. This is where professional habits begin. A trader searching for character change is not asking whether a reversal exists. He is asking whether the market is behaving differently than it behaved before. The distinction matters. One approach hunts for answers. The other gathers evidence. Evidence requires comparison, and comparison requires routine. If you do not regularly observe the same characteristics, you cannot recognize when those characteristics change. Think about any profession that depends on diagnosis. The expert is not effective because he occasionally notices something unusual. He is effective because he knows what normal looks like. Only then can abnormal behavior stand out. The same principle applies to trend reversals. A market cannot appear different unless you have a clear understanding of how it normally behaves. This understanding develops through repetition. Day after day, you observe the same market. You study how it advances. You study how it reacts. You study how it responds to pressure. Over time, patterns of behavior become familiar, and familiarity creates sensitivity. Small changes that once went unnoticed begin attracting attention. What previously appeared random begins revealing structure. Have you ever revisited a chart and suddenly noticed something obvious that you completely missed before? The information was always there. Your process simply wasn't developed enough to recognize it. That is why consistency matters more than complexity. Many traders spend their time searching for new techniques. Meanwhile, they never develop a routine for observing market behavior in a structured way. As a result, every day feels disconnected from the previous one. They start from scratch over and over again. A process eliminates that problem. Each observation builds on previous observations. Each day adds context to the next. Gradually, the market becomes less like a collection of isolated events and more like an ongoing story. And stories become easier to follow when you have been reading every chapter. The practical application is straightforward. Create a daily habit of examining market behavior through the same lens each time. Not to find trades, not to make predictions, simply to identify whether behavior is remaining consistent or beginning to change. The goal is observation before interpretation. Over time, this practice develops a valuable reference point. You stop evaluating the market against your expectations. You start evaluating it against its own history. That shift improves clarity because the market is no longer being judged by opinion. It is being judged by comparison. And comparison has a way of revealing changes that isolated observations miss. A single day may not tell you much. A sequence of days often tells you everything. This is why professionals place so much value on routine. Routine creates continuity. Continuity creates context. Context makes character change visible. Without that foundation, reversals often appear sudden and unpredictable. With that foundation, they frequently appear as the natural result of behavioral shifts that have been developing for some time. A trend does not become dangerous only after it reverses. It becomes dangerous when it starts behaving differently while you are still managing the position as if nothing has changed. This is where trade management becomes critical. The challenge is not identifying the exact moment of reversal. The challenge is responding appropriately when the trend begins losing the characteristics that justified the trade in the first place. Every position is built on a condition. You entered because the market was behaving a certain way. It was advancing efficiently. It was declining consistently. It was demonstrating qualities that supported your original premise. But what happens when those qualities begin to fade? Do you continue managing the position the same way? You shouldn't, because the position and the market are no longer in the same relationship. A healthy trend creates confidence in continuation. A weakening trend introduces uncertainty. When uncertainty increases, management must adapt. Cause and effect. The condition of the trend determines the condition of the trade. As the trend weakens, the assumptions supporting the position become less reliable. And when assumptions become less reliable, exposure requires greater scrutiny. This is why experienced traders pay close attention to character change while already holding a position. Not because they are searching for reasons to exit, because they are monitoring whether the original conditions still exist. Think of it this way. A position is not a static decision. It is an ongoing agreement between your capital and the market. As long as the market continues honoring the conditions that justified the trade, the agreement remains intact. When those conditions begin changing, the agreement must be reassessed. The mistake many traders make is treating management as a fixed process. They decide where to enter. They decide where to exit. Then they ignore everything that happens in between. But markets are dynamic. A trend can transition from strong to vulnerable long before it actually reverses. And that transition contains valuable information. Have you ever watched a profitable position become increasingly difficult to hold? Not because of fear, because the market itself felt different. Price movement became less decisive. Progress slowed. Reactions became more erratic. The trade started demanding more patience while delivering less reward. Those changes matter. They are signals that the environment supporting the position may be deteriorating. Notice what is happening here. You are not managing based on prediction. You are managing based on condition. That distinction is important. The goal is not to assume a reversal is coming. The goal is to recognize that the trend is no longer displaying the same level of health it once did. A healthy trend often earns greater patience. A weakening trend often earns greater caution. Not because the outcome is known, but because the quality of the underlying environment has changed. This perspective transforms trade management from a rigid exercise into a responsive one. Instead of asking, has the reversal happened? You begin asking, is the trend still behaving in a way that supports my position? That question keeps your attention focused on the present condition of the market, rather than on future predictions. The practical application is straightforward. Regularly compare the current behavior of the trend to the behavior that originally justified the trade. Is movement still efficient? Is progress still consistent? Is the trend still producing the characteristics that supported your thesis? If the answer remains yes, the position continues to have support. If the answer becomes less clear, the trade deserves closer examination. Not because weakness guarantees reversal, because weakening conditions change the balance between opportunity and risk, and successful trade management often comes down to recognizing that balance before the market makes the decision for you. Not every sign of weakness is a reversal. That simple fact is responsible for countless unnecessary losses. The market pauses. Traders call a top. The market pulls back. Traders call a top again. A sharp sell-off appears. Confidence grows. Then the trend resumes, leaving reversal traders trapped on the wrong side of the move. The problem is not that weakness was observed. The problem is that weakness was misclassified. A temporary interruption was mistaken for a permanent change. This happens because certain signals have a way of looking more important than they actually are. They create the appearance of a reversal without providing the substance of one. The first false signal is the sharp counter-trend move. A market can travel aggressively against the prevailing trend and still remain within the normal behavior of that trend. Speed alone does not confirm a reversal. In fact, strong trends often produce surprisingly violent corrections. Those corrections remove weaker participants, relieve pressure, and create room for the trend to continue. Have you ever noticed how some of the most convincing sell-offs occur right before the market resumes climbing? That is because movement and meaning are not always the same thing. A large move attracts attention. A genuine reversal requires more than attention. The second false signal is the new extreme. A market reaches a level that appears unsustainable. Price feels too high. Price feels too low. Traders begin assuming that an extreme condition must lead to a reversal. Yet markets are not constrained by what feels reasonable. A trend can remain extended far longer than expected. The mistake occurs when traders treat distance traveled as evidence of imminent change.